Luke Browne is now here with us for the interaction which we promised from the emerging market point of view. Luke, good afternoon and thanks very much for joining us on the show today. Investors in our part of the region are getting a bit skittish now. There's been a very sharp emerging market rally, probably partly fueled by the global central bank action. What are your thoughts right now on emerging market as a asset class?
Good afternoon, and firstly, thank you for having me again. Okay, so it's a great question. I think to best answer that, we do need to continue to look at the global economy. We need to look at the actions that have been taken by central banks, and I think one thing is dominating the path of markets at the moment. That one thing is liquidity. The size, the scale of the monetary intervention of proposed fiscal policies is greater than we have seen. Now, the impact of that and specific actions that have been taken, of course, is very constructive for risk assets. Now, if I look to the impact specifically to emerging markets, and I look at the behavior of markets over the past few months since the major correction that we saw in March and April of this year, emerging markets, of course, as you know, have recovered. I think that the recovery there has been less dramatic than we have seen in certain developed markets, certainly from the S&P. However, on a forward-looking basis, notwithstanding the likelihood of ongoing immediate volatility, I think the opportunity set and the potential growth relative to developed markets is extremely constructive for allocation into emerging economies.
Right. Luke, how are you looking at the valuations right now overall for risky assets, and within that, emerging markets as a space?
Yeah, look, I think the challenge here is that fundamentals valuations are not really the primary driver. Now, what I do like to look at is the potential emergence from coronavirus, the impact of the stimulus we've seen, and the ability to increase the velocity to get back to the growth path that we saw before that. Now, looking at emerging markets specifically, I do observe that the post-correction, the valuations are much more attractive relative to long-term norms. And again, this feeds into the idea that this affords us investment opportunity. And these opportunities that we see need to be exploited, but they need to be done in a very considered manner. At the moment, if you look at the way markets are behaving, it is a risk-on environment. I know that we have seen a correction over the past couple of days, and these episodes of sort of intra-period volatility do need to be watched carefully. However, just because of some of the headline risk, and we've seen increasing cases of coronavirus, particularly in the US, also the fact that we are going through periodic rebalancing, where many institutional investors will take this opportunity to lock in some of the gains that they have seen from being long equity and risk assets in particular. So mindful of all of those factors, selective allocation into emerging markets, I do think certainly for the medium to long-term outlook is a compelling investment opportunity.
Right. How are you analyzing the commentary coming out of global central banks and the way markets are really analyzing and factoring it in? And how long can this, what do you see would be the end game for it?
Okay, so obviously two parts to that question. Now, in terms of the macro landscape and policy response from central banks, of course, this is something that we, like or other institutional investors, will watch extremely closely. One of the things that we do note is the impact of headline risk, the sort of immediate market reaction based on interpretation of commentary. Now, what I do see that is consistent across the board, and whether it's the Federal Reserve, whether it's the Bank of England, whether it is the ECB, we are getting very strong, considered and consolidated messaging that what needs to be done will be done. My expectation is that we're likely to see further easing, further liquidity and further support coming out from central banks. And then in terms of the impact that has on markets, well, I think, one of the best things to look at over how positive this can be is not just within the equity space, but the actions the Fed took, in particular in credit markets, and then, of course, moving from ETF purchase to individual bonds has been hugely constructive on the credit side. Now, the second part of your question was more in terms of what the end game is and what do we ultimately see evolving. Now, the challenge here, I think, is that as we're watching the macro landscape evolve, the data that we are coming out, which of course is more backward looking versus some of the forward looking indicators that are helping us drive allocations for future returns, the end game is the most challenging thing. I think, if we look from one spectrum, which would be the sort of inflationary environment, in all likelihood, we are in a short-term deflationary cycle. However, longer term, I think inflationary pressures are likely to emerge, and this is no bad thing. Inflation, as long as it is contained, can be very encouraging, particularly for risk assets. What we do need to consider is, as the economies emerge from lockdown, what is the impact on employment? We obviously have a huge number of furlough schemes across the globe. Is employment going to return to previous levels? Are consumers going to spend? Let's not forget that emergence from lockdown doesn't necessarily mean that everything goes back to the way it was. I do expect economies to behave differently in future, and the velocity of return is going to be primarily driven, in my opinion, by those actions of consumers and the ability to genuinely reopen economies and get back to a new normal.
Right. Luke, at Manulife, how are you analyzing the prospect for India as a market? Now, we all know that Manulife has just clinched a partnership here in India with the Mahindras and is looking at this market a little more closely than perhaps earlier. Looking at the macros and the fundamentals, where does India stack, in your view, overall in emerging market pack?
Yeah, so look, obviously it's hugely encouraging for us to have such a strong partnership with Mahindra. And then, specifically in terms of the Indian markets, I think, if we look at the response of the Indian central bank so far, I would argue that they could be more bold. Looking forwards, and as India itself emerges from lockdown and the impact of coronavirus, I think one of the great factors that India as an investment has in its favor is the amount of policy response, the amount of powder that is still dry. India is in a very robust state in that regard and has the capacity to do more. Further, if I look at Indian equity specifically, and we talked previously about fundamentals and long-term valuations, the Indian stock market is now trading comfortably below 10-year means. Now, what that suggests to me is that from a fundamental basis, India is a very attractive investment opportunity. Now, I do need to balance that again with the potential short-term volatility that we will continue to see in markets. I think as things evolve over the summer and we go into Q4 this year, you're going to be in a much better place to understand whether we are genuinely in emergence from the impacts of coronavirus, and critically, what the velocity of that emergence is going to be. Should we maintain the speed that we have seen so far? Should this be supported by ongoing liquidity, including potential bold actions within India? Then I think you can really see an acceleration in growth rates. And indeed, that is going to translate into a very constructive outlook for Indian equities in particular.
Luke, how do you really analyze the sharp rally in gold prices? Here in India as well, they've crossed the 50,000 rupee for 10 gram mark, globally to 8-year high. Is there a risk off which is massively on, and how long do you think this could actually continue?
Yeah, so gold is a very interesting investment opportunity, and one that in many portfolios we do have a long bias towards gold, and that's for a number of reasons. So first of all, if we look at many of the shorter term technical indicators, these are constructive and are forming patterns that would suggest that there is the potential for gold prices to go higher. If I look at it on more of a fundamental basis and the utility of holding a gold position in portfolios, it does typically offer defensive characteristics. It is a safe haven of sorts. I think also tying it into my comments over the potential shift from deflation to a more inflationary environment, this is also constructive for a gold long position. Now, in terms of where it can go, clearly, as ever, this is going to be a function of how markets evolve. But, I do think that, there is a meaningful gain still to be had from having that position. But I would think about it in the context of an overall portfolio and its utility within that, either through an allocation to generate returns and or those defensive characteristics that could help shield against that shorter term volatility I talked about.
Okay, my last question, Luke, say 12 to 24 month far out, what's your view on global risky assets, equities in particular, emerging market equities? Do you see them in better shape than now as recovery sets in, or do you think everything depends on a medical solution to COVID and the shape of the recovery actually?
Yeah, I mean, look, all of these things are clearly very closely interlinked. Now, if I look at the tailwinds that we can see, if we continue on the path of stimulus, if we continue to see regular and consistent strong emergence and improving macroeconomic data, then this is clearly a very strong support level for risk assets in general. And I would argue that emerging markets coupled with potentially lower US dollar, potentially ongoing suppressed prices of crude oil should be constructive for those markets and give the opportunity to outperform relative to developed markets. Now, clearly the challenge in looking 12 to 24 months out, as you note, the big unknown is what is the ongoing impact of coronavirus going to be? Now, the way I'm looking at this at the moment is that clearly we can look at China and other Asian economies which were first in, first out. What have been the second wave impacts? Clearly there have been some, but this is somewhat muted. If I look at Hong Kong in particular, the new cases of coronavirus are almost exclusively imported. Hong Kong, and unfortunately bringing the coronavirus with them. So it seems to be contained. Were we to see a development on the medical side and there be inoculation, vaccination, or effective treatment, then I think that is going to be the opportunity for some extraordinarily outsized gains in risk assets. That would really be the catalyst, combined with the abundant liquidity and support we see, where you could see outsized gains across the board in risk assets. One word of caution I would have, credit markets, watching these carefully. We've already seen an increase in default rates, particularly in US credits. We also need to look at the potential downgrade in the impact of migration from investment grade into high yield. So cautious optimism looking forward, but as ever, we need to be very considered and very cautious about how we take those exposures and nimbly and actively manage those positions to take opportunities, but critically getting out of those assets when we start to see negative views or sentiment bleeding into those markets.
Right. All right, Luke, always great to have you on the channel. Thanks so much for your time and have a great day ahead. That was Luke Browne of Manulife Investment Management joining us from London.